Buenas tardes, bienvenidos una vez más a Casting Strategies. Hoy nuevamente en este set que tenemos preparado para entrevistar a inversores americanos que intentamos acercar a todos los seguidores de Casting Strategies. Hoy uno de estos inversores americanos es Meb Faber, es Portfolio Manager y fundador de Cambria Funds, una de esas casas que ha preparado y que está metida dentro de lo que es crear ETFs especiales para que los inversores puedan encontrar dentro del universo de ETFs fondos, ETFs cotizados, pero con diferentes estrategias. No solo dentro del mundo de los ETFs está la idea de la indexación y la idea de comprar por market cap, sino que hay la posibilidad de encontrar ETFs como los de Cambria Funds, como los de Meb, que hoy vamos a conocer y que están basados pues en el conocimiento value, en todo lo que es el universo value y en todo lo que es conocer el mercado y buscar las mejores oportunidades de inversión. Hi Meb, how are you? Thank you very much for being with us. This is a great pleasure to talk with you this afternoon. And we are very happy to have the chance to interview you today. The first question that I always make to all investors that I meet here in our interviews is why you became an investor. Why Meb became was attracted by the market and became an investor and finally a portfolio manager.
Man, well, thanks for having me, guys. First of all, happy holidays to everyone. Happy end of the year. Happy end of the decade. Crazy to think about. But you got me reflective already, looking back. Well, how long you got and how much time do you want to spend on this? But, you know, I think for many people, certainly the investing bug or gene, depending on your point of view, was pretty early. Certainly remember following companies and investments throughout my childhood, honestly, but more from the sexy business side of it, you know, and really was also interested in many other things. Eventually studied science and engineering and didn't really consider investing a career really till post-university. Had started out in the biotech stock world as an equity analyst, but like many people and like many young 20-year-olds that don't know what they want to be when they grow up, I still don't know what I want to be when I grow up, is that your path is somewhat determined by the little tiny baby decisions you make along the way that seem like baby decisions but end up becoming big decisions over the course of a career, little windy forks in the road. And for me, a lot of that was really instituted by the fact that I had a lot of the behavioral biases and mistakes that many investors make, hopefully earlier in their career when they don't have a lot of money, that push me towards decisions and experiences that eventually led me to becoming a quant. You know, namely, I, like many investors, struggled with emotions and the challenges of coming up with a thoughtful and deliberate investing plan rather than just sort of shooting from the hip and waking up in the morning deciding what investments look good, what comes across your plate that day. I imagine if the young me was young in 2019, I'd probably be interested in Tesla and Bitcoin today. But it's really having made a lot of mistakes, having lost a lot of money as a young investor, that you start to craft your approach. And some people, like Warren Buffett says, you're inoculated with the value gene from the get-go. And other people's like me, eventually it's much more of a quantitative approach and say, I want it to be rules-based. I want it to be, for the most part, objective, to guide me rather than having my hands on the steering wheel of struggling each morning with emotions. And so those early formative years ended up becoming a career, and have been doing it, for Cambria for over a decade now.
Okay, Meb, so I got a question here. How do you see value currently? As you know, there are lots of people saying at a time that the death of value has come. This is one thing. But the markets over the past decade have been driven by growth, especially in that case over the last decade. So from a contrarian perspective, we could agree on the coming back of value as a certainty. So do you think value could take over for the next decade that is to come?
So value is important from the standpoint of it's the base case. And if you ignore valuation, I think that's where a lot of investors get into trouble. And it's easy to do, and it's seductive because so much of investing in our world is driven by narratives, where you're telling stories about a company or a hot new idea or product. And it's very easy to get seduced into buying something. And this could apply to houses or cars or baseball cards or anything, collectibles in particular, that have not necessarily a tether to value because it sounds exciting and sexy, and it's a story that people get sucked into. The nice thing about using value is at least it gives you some sort of base case, a rudder to which to say, hey, look, maybe I take a step back. Does this seem reasonable? Am I using common sense here? Maybe, maybe not. And so, as you look at, say, for example, an investment, say, is it trading at a discount to intrinsic value? And buying cheap companies, cheap stocks, markets has worked throughout history, certainly back to the time of Ben Graham, well over 100 years ago. But also the converse is true, and I think a lot of people forget this, but it's equally, if not as important, is that it's equally important not just to buy the cheap stuff, but also to avoid the expensive, because that's often where the really big, dumb mistakes happen. So if you buy markets that are trading at P ratios of 50 or 100 or 200 or don't even have earnings, that could end up fine, by the way. There are investments, if they're growing fast enough, that's a totally reasonable value investment. But on average, buying things that are very expensive turns out to be usually a foolish idea. So, the original question, what does value look like around the world? I used to tell people when they asked me about our investment strategies or any investment strategies, they would say, Meb, how long should I give this to see if it works? And I used to say 10 years, because most people think in times of months, quarters, maybe a year or two. And so that always surprised them, and they would laugh when they say, well, what do you say now? And I say 20. Because if you look back at history, if you're a student of history, one of my favorite investing books, Triumph of the Optimist, is written by a couple of European professors, but it's $100. So you can find the free version online called Global Investment Returns Yearbook. There's about 10 years of it. You should read all of them. It's his partner with Credit Suisse. But they look back at markets throughout history, all the way back to 1900 with stocks, bonds, and bills. And anyway, if you look at history, you find times where not just various investments outperform and underperform, but styles as well. So value being one that's added returns over time over the base case, just market cap weighted benchmark. So what does the world look like now? Well, there's good news and there's bad news. Post-financial crisis, you could have bought anything in the financial crisis and probably done well. That's a decade ago now, crazy to think. But in reality, the big returns have come from U.S. stocks, my home market, for the past 10 years. And a lot of the rest of the world hasn't necessarily participated. Some countries have, some countries have done very poorly. But if you look at valuations, we like to take a very long-term perspective. So we look at 10-year price-earnings ratios for countries all around the world. And as a base case, this is called, Professor Schiller popularized this concept, calls it the CAPE ratio, cyclically adjusted price-earnings ratio. And all that means is 10 years to price to earnings adjusted for inflation. So you can compare different points in history to try to be apples to apples versus apples to oranges. And what you find that historically markets have traded around a PE ratio of 16 or 17, but at times they've been as low as 5. And at times, depending on the market, the highest the US has ever been is 45, but other countries have been 60, and including the highest level we've ever seen in the entire database, which is Japan in the 1980s, at a PE ratio of almost 100. So turns out sorting countries or markets by price-earnings ratio works well historically. Same thing if you did it by dividends, by the way. All these types of value are really blunt tools. And in my mind, they all say the same general thing, that if you're looking at a really cheap market, all the valuation metrics should agree. If you're looking at an expensive market, all the valuation metrics should agree. So people go crazy when we talk about CAPE ratio, but really it doesn't matter that much. Yeah. That having been said, if you look at the world today, the United States is one of the most expensive markets. It's not awful. It's not terrible. It's trading at a P/E ratio of around 30. And compare that to a decade ago when it was in the low teens, and it's been a doubling of the multiple over time. But all that really means historically, if you plug that into John Bogle's equation that's well over, I think, 30 years old now, it kind of forecasts what equity markets are supposed to do based on starting dividend yield, dividend growth, and valuation. It gets you to sort of a low single-digit return number. And before he passed away, he said about 4% a year for U.S. stocks over the next decade, which is much less than the historical almost 10% returns per year we've received for over 100 years. So that's the bad news. But it's not terrible news, by the way. It's not minus 5% a year. The good news is most of the rest of the world is pretty cheap. We track 45 countries all around the world in developed and emerging markets. And most of the world, the foreign developed, foreign for us, outside the US, trades at around P/E ratio of around 20. And then foreign emerging is downright cheap. Depending on the index, it's around 15. And if you look at the cheapest of the cheap, the countries that are really cheap, it's down in a bucket around 12, which is pretty low. You know, that's less than half the valuation of the United States. And so the challenge for a lot of investors, and this is true in Spain, it's true in the US, it's true in Japan, it's true in Australia, is they put almost all their money in their own market. And they do it because it's comfortable, because it feels safe, they understand the companies in that market. But it's a massive concentration risk that's not well rewarded. It's particularly foolish in countries that have a small percentage of the total pie as far as world market cap. In the US, it's particularly foolish right now because the US is one of the most expensive markets in the world. So diversifying globally, particularly in the US based, hasn't worked over the past decade because the US stock market has stomped everything. Yeah. One of my favorite pieces that came out in 2019 was a Bridgewater piece on global diversification. It's free online, but it looks at how rare that is for the US to be one of the top performing markets going back all the way to 1900. And in fact, if you just equal weighted a bunch of countries or value weighted, you would have beaten picking any single market almost always with lower risk and lower valuations. So the good news is if you buy a diversified portfolio of countries around the world, of sectors, of stocks, you should have pretty decent returns. And on top of that, if you tilt towards value, you actually, I think, have the chance to outperform. Part of that is due to the fact that value is done so poorly. So tying this long answer back to the original comment you made on investment styles and asset classes, it's hard to become what we call asset class agnostic. You know, most people want to say, I'm a diehard, even if it's value guy, or I'm a gold bug, or I'm a crypto person, or I invest in XYZ, and they have a very narrow focus. And it's really hard to take a step back and say, look, I want to be agnostic to all of the opportunity set of investments all around the world. And I want to pick and choose when those investments are most opportunistic. And usually, almost always, that's you want to be investing in the things that have done poorly for very long periods, rather than the things that have done really well. And so in this case, values had a pretty historic stretch of underperformance across almost any measure that you can look at versus market cap or versus growth. We think it's a wonderful addition to a portfolio. And we always say you don't have to go full steam concentrated in something. Yeah. You can simply tilt and end up in a better place than you would otherwise.
One thing that surprised me a lot when I'm listening to you talking is that you say that one of your favorite books is a European book about investments. You say that you are forecasting 45 countries. And you also wrote books about global asset allocation, global value, and you are talking about investment all around the world. So this is not so usual for an American investor, that they used to be focused in the American market. You know, the American market is so big and you have great companies there. So most of the American investors, they are focused only in United States markets. How and why are you so globally focused in your ideas of investment or in your background of study? It's not so common and it's surprising me. I would like to know, why did you do that? And how do you find that this was a good way for you to invest?
So if you look, I think one of the most important things you can do as a investor for a lot of reasons, not just about expectations, but also just having a full quiver of knowledge, is to study as much market history as possible. And Triumph the Optimist is a wonderful book. And there's many, many others. We did a post online about, like, I think it's called Learning to Invest. And there's another one called The #1 Investing Book, where we talked about our top 10 and 50 books, many of which we talk about market history. And if you study market history, let's say, by the way, it's getting close to being the end of the decade. We're all drinking champagne or some sangria or a beer at the end of the year, or coffee or matcha tea, whatever may be your drink of choice. Toasting the year, looking back, but say, let's look back also throughout all of history. And you learn a lot of things. The world looked very different, say, in 1900 than it looks in 2019. Stock markets were almost entirely dominated by railroad companies. The US wasn't the largest market cap stock market in the world. It was a much smaller portion. And had you made a bet somehow that the US is going to go from 15% of the world market cap to well over 50, a lot of people would have taken that bet, right? You would have also probably put bets on a lot of other countries to become the biggest market cap. Certainly many people believed Argentina, any number of countries that could have grown to be one of the biggest economies in the world. So, but you look back in history and you also learn a lot of things and lessons. Let me give you an example. You learn that historically, we like to call this the rule of 5-2-1. So if you look at stock markets historically, bonds and bills after inflation, stock markets historically around the world have returned about 5% per year, bonds about 2%, and bills about 1%. And that's after inflation. So you add on inflation, and it gets you up to the historical 9%, yada, yada, yada. But in huge spread of possible outcomes. So for example, I think the best performing stock market of the past 120 years was South Africa. And there was other cases of stock markets essentially going to zero. In China, in Russia, the stock markets essentially shut down when the governments decided to close the capital markets. Other countries, many of them, experienced declines of well over 80%, 90%, including the US, which is one of the best performing stock markets in the world. And the Great Depression had a massive, massive loss of wealth, right? And so if you start to lose 75%, you got to remember, investors, it's not 75% to get back to even, it's 300%. So these massive, massive losses. So you learn some lessons, okay? When you study history, you learn what's possible. You say, hey, how can I protect myself if that's going to happen here? What are the things I can add to the portfolio? And they don't have to be massive changes. They could just be little tilts like, hey, I'm going to be a global investor because in the next century, it's probably not going to be the US, which is going to be the massive growth engine. It could be Africa. Who knows? It could be Asia. It could be Europe. I mean, it's hard to know where exactly some of these free market inventions, Elon Musk could invent free energy. Who knows what's going to happen? So to have the diversified bets on what we really call the three big ways to make money. It's the hold the keys, which is real estate and land. And most people can really associate with that over time. Be the bank. So for a lot of people, own the bank. A lot of people lending or owning bonds. And lastly, and the most important, is to be the boss, which we call, investing in companies and businesses. And it's particularly interesting in 2019 because 50, 100 years ago, when you invested in a U.S. company, for the most part, you got a U.S. company domiciled in the U.S. with most of its revenue from the U.S. Same thing, Germany, Spain, Australia, Japan, etc. 2019, you can be investing in an Australian company that gets 100% of its revenue from China. Is that a Chinese company? Is it an Australian company? In so much of the world today, the revenues are cross-border, sectors are somewhat meaningless. So it's even more important, we think, in 2019, to be totally geography agnostic as well as sector agnostic, because you don't know where some of these major big returns are coming from. If you look back at history, this is even more important too. And the distribution of returns. It turns out that if you look at just stocks, roughly half the stocks out there don't have a positive return over their lifetime. Roughly 2/3 can't even beat the index. And almost all of the returns come from this tiny 5% of stocks. It's the Amazons, the Tencents, the Walmarts of the world, these massive companies that have, not massive at the time, but have major success in part of free markets and capitalism. And so one of the best things you can do, if you look at the lessons of history, is that you can take a little bit of your sweat and labor and put it into others' sweat and labor. And that's investing in companies and investing in stocks. You could do it in private market, you could do it in public stock market. And historically, that's generated a great return. But the whole point in this day and age is that could be anywhere. It could be a startup in Asia, it could be a startup in South Africa, it could be a mature company, who knows. But there's a lot of great books on the subject. You can link to many of them. You mentioned ours, which are free to download, by the way. That you don't have to live through all the mistakes, like certainly I did and many others have, but to try to learn from others over the past 100, 200 years.
Right. Interesting because currently in the seeing the macro side of things, actually, I see now that we have a inflationary dynamics, we have a deglobalization dynamics, we have let's say the federal debt is going through the roof. So we have the trading war, the Brexit. So we have kind of a myriad of things that could bring maybe over the next years. A lot of people claims that let's say a crash is around the corner. So and then I learned about your Trinity portfolio and the portfolio that you manage in the global asset allocation book, also where you describe that idea about 3/3, where you use stocks, you use bonds, and you use these kind of trend strategies that you mentioned. And this is the Trinity portfolio actually, and the GAA portfolio, where you blend also emerging markets, US large cap, you use 3 years bonds, so you use many things at a time, many different asset classes. So I'd like to understand a little bit more about the Trinity strategy, the Trinity portfolio strategy, because given the GAA portfolio, that it makes sense from my point of view, it makes sense, to use this kind of portfolio for the next years. How do you manage this idea about trend strategies within the portfolio?
Sure. So there's a lot wrapped in that. The first part, you talked a little bit about geopolitical news. In 2019, everyone is so engaged in social media and just bombarded with news flow all day long. And it's almost impossible to be a public markets investor. You want to spend all day selling everything, worrying about a crash, because the news flow is almost always negative. The media is encouraged to write negative stories. And that makes it harder, I think, to be a long-term investor and have perspective. And so, but the challenge is you look back in history, and there's never been a better time to be a human. I certainly wouldn't want to be living 100, 200, 300 years ago. We'd probably all be dead. Our life expectancy was so much lower. But the challenge is there's always negative news flow. And going back to the very beginning part of the discussion, is one of the reasons I became a quant. I said, look, I want to set up rules for this portfolio. And the vast majority of people don't have a written investment plan. So listeners, that's one of the best things you can do is write down what your plan is. So that way you can review it when inevitable bad times happen, whether it's global stock markets go down 40, 60%, whether it's gold is up 50, down 50, whether it's crypto went up 100x or down 90, whatever's going to happen, you have a plan for it going forward. Because the worst thing that can happen is bad times happen. You don't have a plan, you sell everything, go crazy. And that's what happens to most people is they never buy in again. And it just totally decimates a portfolio. So let me give you a good base case from which to start. And we talk about this in our book, Global Asset Allocation, is it says, if you were just to buy all the assets in the world, let's say you took a step back and say, I want to buy every possible public investment in the entire world in the proportion that it is of the world, you end up with about half in stocks and about half in bonds, okay? And that's every type of stock from all around the world. That's every type of bond, not just governments, but also corporate bonds, et cetera, et cetera, et cetera. And about half of that is in the US, and about half of that is ex-US. Now, that's called the global market portfolio. There's two asset classes that are pretty big on the private side, private real estate and land and farmland. But for the most part, it's a pretty good approximation of the public markets. we would argue that it may not be as representative of the global economy because the US as a percentage of the global GDP is only about 20%, as a percentage of population is much less. But in general, it's a good starting point. And it turns out that global market portfolio, which by the way, isn't US dominated always. If you go back to the 1980s, Japan was the biggest country by market cap, and you go back before that, it was UK, et cetera, right? But you get a nice diversified global portfolio. And it turns out that simple, do nothing, buy and hold asset allocation portfolio is probably going to beat most investors, including most institutions. We've done a few articles on the blog called Should Harvard Be Managed by a Robot? Should CalPERS be automated? And it turns out it's pretty difficult to beat this basic global market portfolio. Now, the challenge with global market portfolio is that market cap weighting, which is the original index, which is just you buy stocks in proportion to how big they are, if you think about it, isn't an optimal investing strategy, right? There's no tether to value. So there's tilts you can do to that portfolio that improve the returns. The first one we spent some time earlier talking about, which is value. You tilt towards cheaper companies, countries, sectors, whatever it may be. And that ends up adding some performance over time. Same thing can happen in bond markets, but we're not going to get into that right now, or we'll have to come back next year and talk about it for another hour. Because you mentioned the concept of trend following. And so earlier when we talked about the two pillars of investing, value being one for us, trend following being the other. And trend following also has a super long history, well over 100 years. Back when Ben Graham was around, before that, there was Charles Dow was talking about trend following, the person who started the Wall Street Journal. And he was writing articles about Dow theory, and you could even take it back hundreds of years before that. But this concept of buying investments, holding on while they have these really long-term gains, but cutting your losses. So letting your winners run and cutting your losses. And this is one of the hardest things to do in investing. Most people want to hold on to the investments that are losing money because they say, "Oh, I'm gonna hold on till it gets back to even." Yeah. Or, "Oh man, that was so stupid. There's no point selling it now." And that's where people get in trouble. But when they have an investment, say you make an investment and it doubles, people are like, "Oh my God, I have to sell it." Mm-hmm. But often cases that investment could be the next McDonald's or Walmart, Amazon, Nike, where it goes up not just 1x, it goes up 10x, 100x, and that's really becomes life-changing wealth, which is a part of the market cap investing. If you buy the market, you are guaranteed to own those. But if you take a trend-following approach, and we'll mix in momentum, and so they're kind of close cousins. Trend following is something going up or is it going down? And there's plenty of statistical measures you can use. We love long-term moving averages, but there's plenty of them. Really what you're avoiding is trying to stay out of investments that go to zero. And the momentum is the close cousin, and we say it's like race cars going around the track, is what investment is doing better than the other one. So if you're comparing gold to real estate to bonds to stocks, which one's best? So you can kind of put those two together into a portfolio that has some outperforming characteristics that look nothing like buy and hold. The problem is neither one of these both these investment strategies are great historically. You can take them back 100 years. Neither is easy. Buy and hold is hard because in a 2008, 2009 environment, it's really difficult for people to sit on their hands and say, "I'm doing nothing while the market declines." Because there is no technical bottom. Markets are crazy, right? The markets are psychotic. They can do things where they have huge losses. But trend following is hard, not because of that, because usually during long bear markets, trend following strategies get out. They either sit in cash or bonds or some even short. It's hard at other times. This is a good decade as an example in the US, where the US stock market is romping and stomping and beating everything else. Trend following may not look as good in comparison. It's not as good in sideways markets. So we've come up with this philosophy. This is what I do with almost all my money, is put the two together. Say I want to put half my money in a buy and hold, globally diversified asset set, gives you stocks, bonds, real estate, all that good stuff, tilts towards value. On the other half, I'm going to use momentum and trend in case that we can be up to 100% cash and bonds in those portfolios if everything's going south. And it's sort of a yin-yang portfolio that fits together in a nice way that keeps me behaviorally not having to feel like I'm in a binary situation, which I have to be all in or all out. And most investors love to think in these terms when they're betting on the local football team or they're cheering for an investment. They always want to be, "Hey, I'm cheering," or "I'm against this investment." And very rarely do people want to be diversified secretly because they like to gamble. and part of which is it's more exciting. But the approach of putting all these ideas into one, I think, is one that checks most of the boxes on the behavioral side of how do I keep myself from doing something really, really stupid and ruining my chances at investment success. And this has been honed over 20 years of my mistakes and ideas. So, but going back to what we talked about over this whole period, this is what's most important is finding an investment approach that works for you. So this is one that works wonderful for me, but maybe not for everyone.
But I got because that's a question that comes up that you use the trend strategy in that side of the portfolio to allocate the different assets or to rank the assets within an asset class. So I mean,
so it's both.
Both.
It's both. So we look at we use a number of different trend strategies. The main one looks at all the major asset classes in the world. So it'll look at U.S. stocks, emerging market, corporate bonds, foreign, agriculture, precious metals, it's cash, everything. It'll take the top third of those assets. Uh-huh. So the ones that are on the best performing over the past year, as an example, if and only if they're in an uptrend. And if they're not, it'll start to move to cash. And usually, almost always throughout history, something is going up. And there's various cycles. In the late 90s, it was stocks. In the early 2000s, it was bonds and real estate and dividend. In the mid 2000s, it was emerging markets. In the 08, 09, it was cash and bonds. And so usually something is going up. Very rarely is everything going down. But it has that feature where we'll move to cash and bonds if things aren't doing well. Otherwise, it's investing in what the top momentum names are. And right now, that's a lot of global stocks and sectors. There's a smattering of real estate and bonds. I mean, everything had a great year in 2019 for the most part. It was the exact opposite of 2018, where pretty much everything did poorly, which, by the way, tends to be a fairly rare mirror like that. But we're finishing 2019 on a pretty strong year for most assets.
Oh, okay.
Thank you, Meb, for being with us today. It is a pleasure to talk with you, and it has been a pleasure to talk with you today. We would like to have you again in the show talking deeply about other things. I have only one last question that I wanna know. And it's surprising me as well, that what I see right now in the United States markets is that the managers, they used to use or a hedge fund or an ETF. But I see not good managers like you or others looking for or going through the mutual funds, Why in Cambria, in your company, in the company where you are a portfolio manager, why you choose the ETF as the way of applying the strategies that you are using? Because, it's kind of weird for us in Europe this way, but also Toby Carlyle or another good managers, they are doing that.
So, first of all, thanks for having me, guys. I look forward to doing it in person next time in 2020. You're asking a question where investment products in different forms have been around forever. And Wall Street, the best thing Wall Street does is find a way to extract large fees from people in whatever the structure may be. So the number one thing as an investor to do is to try to figure out how to keep Wall Street out of your back pocket. Because they love to do that. But ETF is just another structure, right? I'm like to say I'm agnostic as to structures, but want to pick the best one for investors and myself, because I invest in all of our funds, put all my money into our own funds. So we launch funds that I want to invest in. And so there's never been a better time than 2019 to be an investor. The problem, of course, also is that you have a massive amount of choice. So other than the paralysis of infinite, over 10,000 choices on funds, costs have now essentially almost come down to zero. So transaction costs in many brokerages now are close or at zero already. You can get funds. You can buy the global portfolio in the US today with a basket of ETFs for essentially free.
Yeah.
It's 0.05%. And in most of the rest of the world, it's still pretty expensive just to invest in a basic index, buy and hold, do nothing. But it's never been a better time, and it's only moving one way. And that's a massive change happening in the asset management industry. ETF is just another structure. And the funny thing about the ETF structure, it stands for Exchange Traded Fund, is that ETF was born in the 90s really not as a design. It was more of a workaround. It was a patchwork. And so your ability to launch a fund that ended up having this very quirky tax treatment benefit. And so if you buy a mutual fund in the US and the manager's trading and updating, at the end of the year, you usually get a tax bill based on, do you have long-term capital gains, losses, et cetera. And very often that's a pretty significant tax bill. Morningstar writes a lot about this. Well, the ETF structure brilliantly figured out a way that you could postpone that for the entire history of someone owning the fund. So you buy an ETF in 2019, you don't sell it till 2050, there's a good chance that ETF has never paid out any capital gains distributions ever. Yeah. And that is regardless of how much it's trading. And so it's a brilliant and unique structure that no one really intended to invent, but figured out a exemption to the old rules. Now, what does that mean for the investment management industry? It means in the US, there's really no reason to buy a mutual fund almost ever. Now, there's some asset classes that it doesn't matter as much. So something that uses derivatives like managed futures, a lot of the fixed income ones, because most of the return is just basic income rather than capital gains, doesn't matter as much. But this massive tax benefit for most people in a stock fund is more important than the actual fee. And on top of that, ETFs on average are half the cost of mutual funds. So you have the 0.7% average benefit of the cost on the expense ratio plus a 0.7 benefit on the after-tax potential return. It's a massive spread just from using the structure. Granted, I'm an ETF manager, so take my word at whatever value you think it's worth, but do the research and do the math. And I think we saw a recent research report come out this past week that said ETF assets should surpass mutual fund assets in the next 5 years, because there's really no reason now. But mutual funds, by the way, they should be petitioning the IRS all day long to try to change this. But I think it's too late. I don't think there's any way of going back. So for the most part, the default should be in 2019, you're paying no commissions. You have almost a totally free portfolio, and you use an ETF. And then if you want to pay more for that, you want to get your sexy hedge fund, you want to shoot the lights out with whatever other thing you want to do, that's the base case from which the bar is set. So anyway, again, thanks guys for having me. Love to come back anytime and chat more.
Okay, thank you very much. And also for us, we are lucky that you choose ETFs, because then not most of the people can, but we can buy the Cambria funds from here, from Europe. And it would be totally impossible to do it if it were a mutual fund. So for us, it's great that we have the chance to invest with you. So thank you very much, Ferb. See you again in another show. Thanks for your wise, and thanks for being here this afternoon.
Thanks, guys.
Thank you, Meb. It's been really a pleasure. And maybe it would be interesting if you mentioned your Twitter account and how people could reach you. It would be interesting. And then we say bye-bye. I think that's the fair thing.
Yeah, so you guys are my day jobs at Cambria Funds or CambriaInvestments.com. You can find a lot of articles on the blog at Meb Faber. Certainly subscribe to the podcast. Almost 200 episodes now of the Meb Faber Show. You can watch me pick fights on Twitter at Meb Faber. And by the way, almost all of our books are free to download on those websites. So take them for a spin and let me know what you think.
Awesome.
Okay, thank you very much. Muchas gracias. Aquí dejamos esta entrevista con Meb Faber y nos vemos en próximos casting strategies. Gracias. No olvidéis compartir el vídeo si os ha interesado y suscribiros al canal.